Hi, this is Kerry Artak with Wicked Stocks and Artak Advisory, bringing you an update in the dollar. The U.S. dollar index is the instrument I'll be studying and showing you different chart formations and what I'm looking at with respect to the long-term outlook in the U.S. dollar. The U.S. dollar index is a widely followed index. It has its shortcomings. It doesn't include the Chinese yuan or the Mexican peso, two of our larger trading partners. It's been around since the early 70s. It's used by a lot of banks and institutions for determining, the longer-term market direction, strength, weakness of the U.S. dollar in general. You can see the kind of the weighting here. The euro is by far the largest element within the U.S. dollar index, and then you can just kind of make your way down to the smallest, being the Swiss franc and the Swedish krona, et cetera, et cetera. The Canadian dollar, probably our largest trading partner, is just under 10%. So this chart I'll be showing you throughout much of the video. This is kind of an update. I've been doing these for several years now on YouTube and Artak Advisory. And this chart, as you can see, going back to 1976, so about 50, actually more than 50 years of activity. You can see the February 85 all-time high in the index and the March 08 all-time low in the index. Those are two extreme points that I'm going to be using here to kind of walk you through some studies. If you recall, we've got a long-term rising channel top that was at 114.78 September of 22. If you've been around long enough, you remember this video where I mentioned that this was significant resistance before we tested it. This 114.78, this rising channel top, also at the time, and it's now, by the way, 118.13, well above the market. But the point I'm making is, at that time there was a beautiful convergence in two significant, structures. One being the rising channel top, 114.78, but the other was a descending two-thirds speed line. And in that video, and I'll do it very briefly in this one, it was kind of an instruction on how to create speed lines. So you've got a descending two-thirds speed line that takes into account the February 85 high against the March 08 low. The two-thirds pullback, this horizontal black line, is 133.32. I don't have it labeled here. But it is this horizontal line, and you create a speed line by drawing a trend line from the high that intersects at the exact price point of 133.32 in the time frame in which the low was made. And that would be a trend line that will continue to come down like so, and I can show you in the subsequent charts how it held beautifully. And it converged at the time with the rising channel top. This was the sale of the year, sale of the decade, maybe. Descending two-thirds speed line is now at 109.73. This is still a relevant line study. It will remain valid and in effect as long as we do not retest the 70.69 March 08 low. So it will be a significant upward pivot point into 26-27 if we were to close above it. But this 118.13 channel top has a channel bottom that we are presently in the midst of violating. 97.27 is a representation. It's really the trend line off the lows. 97.27 is presently being tested and violated. And this is the same monthly chart throughout, by the way. I don't think I mentioned that. I'm not using weekly charts. I'm using monthly charts. All of these numbers are good for the month of July, which we just entered. 97.27 is this rising channel bottom, and this channel bottom goes back to the 08 low. So this is a, 17-year channel bottom. Significant long-term trend-defining support level that we are now below. We actually closed below it the month of June by a hair last week. We opened below it the month of July last week. It is now holding resistance, 97.27. The high this week so far, or this month so far for July, is upper left, 97.16. So we are below this channel bottom, but because it's such a long-term line study, and if you follow my wickedstocks.com analysis, my Artak advisory analysis, you know that any line study that exceeds 6 months I like to throw in a 1% violation threshold for what I call a more technically reliable sell signal. In the event we were to close below 97.27 at the end of July, I would want to see that by a full 1% of 96.30 this month for what I would call a technically reliable sell signal. Until then, this is kind of what I would call the stretching of the rubber band, where we're violating this channel bottom, but it hasn't snapped yet to the downside. That would come with a settlement below 96.30, even on an intra-month basis. So any weekly settlement, let's say, below 96.30 has its bearish implications. And I would expect this descending channel bottom at 95.63, that actually may be in reach within the month.
If you're finding value in this analysis, it's only a glimpse of what we offer. Your real trading edge starts at wickedstocks.com. Each week, premium members receive 2 high-probability stock picks. Each one comes with a complete trade plan, including exact entry, profit target, stop loss, and regular updates so you can manage the trade with confidence. You'll also get daily video analysis in the top traded markets, the SPY, the Triple Q, and NVIDIA, highlighting the key price levels, trends, and trade setups we're focused on. Whether you're day trading or swing trading, these insights help you zero in on the highest quality opportunities with clarity. Try it all free for 5 days. Cancel at any time.
Now, of the two, at one point, these two were converging. Back in December, I think the last video I did, these were converging very well, and now they are diverging. So if I were to choose one over the other in terms of a trend-defining line study to follow, it is the 17-year channel bottom at 97.27. This is our pivot point through the rest of the year. We have violated it, but not by the required 1% margin. So there's the possibility of a head fake to the downside where we could pop back above this channel bottom and continue higher into later year. Now, if we close at 96.30 or lower, not only would I expect 95.63 in short order, but I do think that the big picture, this is what we would look at. And we are violating the channel bottom now, just not by the required 1% margin. So if we close at 96.30 or lower at the end of July, then I'm expecting the upper 80s. And this is a rising 2/3 speed line coming off the 2008 low against that September 22 high. And so it is sort of the opposite of what we showed before. It's a rising speed line. It also correlates pretty well with this low area from January of 21 and February of 18. This is a monthly chart. I'm used to watching daily and weekly charts. And so the span of 3 years between these 2 points, you can appreciate the long-term nature of this chart. Closing the month of July 96.30 or lower does set up 88.30 and climbing gradually as this is about a 6-month descent. This could be another 6 months. So yes, if we close the month of July at 96.30 or lower, we can, by the end of the year, see the upper 80s, 88.30. This is a formation that may well contain selling by that point in time, well into 26, and we could come off of that area. If we were to close below 88.30, FYI, I'm just getting way out ahead of the scenario. When you violate a rising 2/3 speed line, and when you close below 88.30, you're then expecting a test of the low from which it's projected, which would take us into the low 70s. So I'm not expecting the low 70s unless we close below 88.30, but I will say that if we close below 90 at or below 96.30, that is a big deal. That is the discontinuation of a 17-year bull trend in the dollar coming off that low, and that would expect at least 88.30. This needs to be respected for its ability to contain quarterly, possibly annual lows, and if tested, we just continue deteriorating into the lower 70s. So let's move on to the next chart. And I've already showed what the objective would be to the downside if we close at 96.30 or lower. But if we don't close below the red line, and if we close certainly back above 97.27 at the end of July, and it doesn't actually have to be at the end of July. I think any weekly settlement above 97.27 during the month of July does neutralize bearish momentum, at least on a near-term basis, enough perhaps to allow a clear settlement at the end of the month above 97.27. And if we can close at or above 97.27, this channel bottom continues to hold. I mean, it is by one measure anyway, because we have not violated the 1% threshold. So if we close back above 97.27, I think within several months we can make our way back to this rising channel bottom at 102.04 and climbing. If you recall in the last video, I mentioned that if we close below this channel bottom, we should see this channel bottom in the 97.27 area. And so now we can rotate back up to 102.04 in the next few months. And if we can close above 102.04, I'm looking for the low 110s again. In fact, it is holding above 97.27. When I say holding, I'm really saying if we don't close at 96.30 or lower, the 1% qualification for this sell signal into the upper 80s. If that doesn't happen, and we close the month above 97.27, there is a solid case to be made, and this is probably 6 to 12 month rally. Remember, these are monthly bars. I don't see this market running to the upside significantly. After all, we're still in the Trump tariff war that hasn't ended, even though it's quieted. The U.S. Congress just passed a spending bill that is going to blow another hole in our debt structure. Our deficits are going to be climbing. There's going to be increased interest rates. You know, in short, American assets are not as appealing as they were 6 months ago because of those two elements primarily. And I'm not trying to get political here. I'm just being economic, right? We've got a tariff war where the president is making threats of 75% even last week against some countries that don't hurry up with the trade accord. And there's, you know, over 70 countries that have yet to come to the table. And so if this continues to play out, and if the budget deficit continues to expand, which it will, based on the most recent passage of the beautiful bill from last week, then the odds, I think, favor 88.30. But from a technical perspective, I don't think you can act on that unless we close at 96.30 or lower at the end of July. Until then, we just might be forging a long-term low, and we shall see. If we close above 97.27 at the end of July, there is a case to be made for upward rotation over the next 6 to 12 months would be my guess to the 110.24 descending channel top. That number should sound somewhat familiar because it presently lines up beautifully with this still active long-term descending two-thirds speed line at 109.73. So I think this image here, going back 50 years, does encapsulate the dynamic through the rest of the year. 97.27 support, yes, we're violating it, but not by the required margin. So there's nothing to do. If you're long dollar-denominated instrument, if you're long the index, now you can trade this index, by the way, on the ICE futures exchange, and there's also an ICE index as well. So this is a tradable entity. So if you're long, if you're at 97.27, if you don't get the violation below 96.30, you might actually be reaching for, say, 110 strike out of the money calls that don't expire. I would go a full year out on that, maybe a couple of years, just to reduce your theta time decay element. And inversely, if we close at 96.30 or lower at the end of July, you may then reach for 89.90 strike out of the money puts. This is probably a 6-month descent, so you might go a year out on that strike. Those are just two basic options plays I could mention. I think that pretty much covers it. I am going to leave it at that for this particular wickedstocks.com and rtechadvisory.com update on the US dollar index. You have a great day.